top 2020 oil picks. Brian Singer of Goldman Sachs lays out his case for why next year could be the year for EOG Resources. Palladium's record-breaking rally. The precious metal tops 2,000. Is there more upside, or can other metals catch up? And Goldman goes green. The big bank will spend $750 billion over the next decade in the climate transition and will curb lending to coal financing. I'm Alix. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On. It's our take on the big story, and our spotlight today is on U.S. E&Ps. And I'm happy to say joining me, Brian Singer, Senior Equity Research Analyst covering the oil and gas exploration and production sector at Goldman Sachs. Now, welcome. I've been wanting to get you on TV for like ever, so this is a big thrill for me. I'm going to highlight a part of your last note where you were saying, we believe that barring a recession, we will see an inflection post-2020 where OPEC production increases, not decreases, and will be needed to maintain inventory stability. This should represent a positive inflection for energy equities. Talk me through the logic.
Yeah, it's a pleasure to be here. Thank you for having us on. That's absolutely right. For the last 3 years, OPEC has needed to reduce production to be able to maintain stability in the oil markets, to maintain stability of oil inventories, and that's weighed particularly on the energy equity sentiment. But we think that's going to shift post-2020. It's a function of both a reduction in the contribution from these big long lead time projects. It's also that shale growth is not what it used to be. And so in 2021, we actually see the opportunity for the world to need more production from OPEC as opposed to less. That has the potential to improve energy equity sentiment.
So if we get there, when you get to 2021, like what's your screen? Because there's so much value in the energy sector because everything's just been really crushed. How do you screen for the real opportunity versus a value trap?
It's a great question because even though we may see an improvement, we're not going back to a world that needs every energy company's production to start growing aggressively again. So we think the theme is going to be more sustainability. And we have an L, an E, an A, and a D to define the leaders of sustainability. L is for leverage, companies that have strong balance sheets. E is for earnings, those that have good free cash flow, corporate returns. A is for asset-based sustainability, and that's those companies that have a low-cost asset base with longevity. And then D is decarbonization, the companies that are contributing to lowering carbon footprints.
So do you have you pick a company that does all of those things, or do you go point by point and say, okay, within leverage, I can't own this company. I'm going to say Chesapeake. I don't know if that's true or not. They have too much leverage, they're underwater, but I could own this company that's reduced leverage.
Ideally, we try to find companies that fit all of those buckets. Now, you don't always find that, but there are a couple that we can highlight here. And EOG Resources is one of them as an example. EOG has a balance sheet that is sub a turn, almost sub a half a turn net debt to EBITDA. They have earnings that are growing double digits, we think, in 2020. They have corporate returns that are double digits, free cash flow yield that's 4 to 5%. Asset-based sustainability, they've got, we think, a very low-cost position across multiple shale plays with exploratory potential. And then on the decarbonization front, we think they've been one of the companies that's been more aggressive with the investment community in engaging on ESG.
So does an EOG need 60, 65, 70 to then attract investors when you do see that call on OPEC increasing in 2021? Or does it not really matter the oil price and more just the underlying environment of we need more OPEC oil, therefore we will need more U.S. shale?
We see EOG as more of a through-the-cycle winner, not necessarily one that has to have that higher price. And we have a view of about $63 a barrel Brent for 2020. In that environment, there's a lot that EOG can do. There's been a debate in the investment community of whether EOG is actually growing too quickly or whether they should focus more on increasing their free cash flow and repurchasing shares. We think they can do it all in 2020 in that they can not only grow oil production in the double digits, closer to 15%, they can have good corporate level returns, free cash flow in the 4 to 5% range, and they may still have cash left over, not only to increase their dividend, but also to initiate a share repurchase.
Those would be pretty good numbers there. Before you go through your screen, what companies may not add up to any of those screens?
Yeah, sure. So you mentioned Chesapeake, and that's one of the companies that, for us, has a weaker balance sheet and one that we don't see meaningfully improving. So that's one that doesn't fall into that category, and as such, we're a little bit more on a relative basis negative, and California Resources would be another one. Of course, the higher the oil price, the better it will be for a lot of these companies. But our view is, well, the energy equity sentiment may improve. We're still going to see oil prices in the $63 Brent range, and then between 60 and 65 beyond that.
So something that's happened is that these producers have surprised on productivity before and new technology to increase productivity. The latest has been sort of when you're drilling, they've just become better at drilling. Now I feel like the question is how better can you frack? How much better can you make that? What if they just do a really good job of that and they wind up oversupplying the market next year?
Yeah, that's a good question. And capital discipline has been something that we've not seen a lot of until recently. But one of the things that you've seen in the over the last year is the bar to attract and retain through the cycle investors continues to rise. And you've seen a significant reduction in the number of equity transactions, debt transactions in the market. And as a result, companies have had to show free cash flow for the first time. And it's great that more and more companies are doing that because it's helping to reduce the oversupply of the market. And we think next year, as an example, U.S. oil production will only be up about 600,000 barrels a day on average, which versus more than 1 million barrels a day in 2018 and 2019.
Meaning that they can get more productive, but that doesn't mean that they're going to all of a sudden increase spending and drill 17 more wells that are more productive.
Yeah, that's right. Now, as you say, the productivity has been going up. We think that there are parts of productivity that are starting to ease or at least decelerate. We still do base case productivity gains in shale for another year. On the efficiency front, yes, companies are still drilling more quickly, and that very well may continue. And it may continue in particular for the companies that have below ground and above ground scale. And EOG and Pioneer, Concho are among the companies that we think are going to see improvements in some combination of productivity or efficiency over the next year.
Now, if you round it out with M&A, Occidental did not do well when it came to its M&A. They stood by it, and investors did not reward them for it. We've started to see smaller players tie up. What's your overall look for consolidation?
Yeah, we think we'll see more of the consolidation because of that need for below and above ground scale. That companies need to find ways, especially as the opportunities for productivity gains work through the system and you start to see shale move closer to maturity, that you're going to see companies really look for how can we get more contiguous acreage positions together, how can we use data, and how can we use technology in the best way to try to keep supply cost either flat or moving down. That likely does mean more consolidation, but frankly, a lot of the companies that we're recommending, the EOGs of the world and the Pioneers of the world, we don't think they need to take that step. We think they've got sustainable, long inventory asset bases on a standalone basis.
Brian, such a pleasure. I really enjoyed talking to you. I read all your reports, really great insight. Brian Singer of Goldman Sachs, thank you very, very much.
Thank you very much for having me.
And check out this, a really weird week for PG&E shares. The bankrupt utility won court approval for 2 multi-billion-dollar wildfire settlements that will serve as a centerpiece of its restructuring plan. There's a $13.5 billion plan to compensate victims of the catastrophic fires that blamed it on its equipment, and an $11 billion deal to settle claims with insurers and investors. At the same time, the utility is still battling California. This time, they're fighting over a clause that would allow the state to take over PG&E under certain circumstances. Governor Gavin Newsom wants it in. PG&E wants it out. This is Bloomberg Commodities Edge. I'm Alix. This is Bloomberg Commodities Edge. Time now for the Data Dig, where we delve deep into the market trends of the week. So first up, you got oil inventory numbers. Overall, they fell by about 1 million barrels, and most of that actually came from the Gulf Coast. You had a pull from the export market versus a build over on the East Coast and a build here in the Midwest. Now you want to watch some run cuts. Refining utilization was lower this past week. And one of the easiest trades, hottest trades of the year in the energy markets is actually one of the trickiest. So here's the background. New shipping rules that take effect on January 1st actually force ships to burn lower sulfur fuel. So the trade seems easy. You want to buy low sulfur fuel, which is the white line, and you want to sell the dirtier stuff, which is that blue line. That didn't quite work because supply was actually tighter for the lower quality fuel and demand higher. Prices moved up, whereas the cleaner oil pretty much did nothing. As a result, the trade has been known as this year's widowmaker, making and breaking some of the biggest commodity firms all around the world. And finally, you got a copper inventory contraction here. Stockpiles contracted to its lowest level in about 5 years. That drawdown comes as prices have climbed to the highest since May following the U.S.-China Phase 1 trade deal. So does that mean copper is a 2020 hot trade? Well, billionaire investor Stanley Druckenmiller, he likes it. He sat down with an exclusive interview with Bloomberg's Eric Schatzker.
I own copper, believe it or not. Basically, I think on the margin, as I just described, particularly with fiscal stimulus and monetary easing at the same time and a diminution of trade worries, global economy is going to be better than the IMF thinks. And copper has a little extra kicker relative to the other ones.
So let's stick to metals here and get into the ring, and this time it's palladium versus palladium. We can call this precious metal rally still going to break through 2,000 next year. Well, I'm joined by Will Ryan, founder and CEO of Granite Shares. First of all, what happened with palladium? Like, I get the underlying supply and demand fundamentals, but lay it out for the audience, and also, is it legit?
Yeah, so palladium is typically a byproduct of another metal, so specifically nickel. And you've had a supply shortage in the nickel market, which has manifested itself in a supply shortage for palladium and pushed prices up to these kind of levels that we've seen now, almost touching $1,900 an ounce, which is over $1,000 an ounce roughly over the price of platinum. So kind of incredible story.
So is the demand there? If it's made as a byproduct, does that mean there's not enough supply, or is it a demand story?
There is definitely demand. So obviously the demand story is mainly from auto catalysts. So the auto industry, the biggest demand source for palladium used in catalytic converters to clean the emissions on cars, particularly in gasoline engine vehicles. So demand is strong, but it's really been a supply story. Mainly this deficit that's happened primarily as a production out of Russia.
Do you see investors coming in as sticky investors or tourist investors?
I think it's kind of interesting. If you look at the flows, particularly in the ETF market, you've actually seen people selling into this rally. So people kind of, I guess, not believing that the price could go this high. So people have been selling all the way up. Now, whether people get back in or not is a different question. But I think now the prices is so high that people have got to be thinking about substitution into platinum, because you can use platinum as a catalyst in catalytic converter for both a gasoline and a diesel engine. I think automakers, other people that are really fueling this demand have got to be looking at that price differential and saying, all things being equal, why am I paying $1,000 an ounce more for palladium when I can use platinum? And so I think we start to see some substitution that affects the swing in terms of platinum favoring palladium.
In terms of the supply picture for platinum, is it the same? Is it as tight as palladium, or is it a different story?
It's a different story with platinum. You don't have the deficit or the shortage that you do in palladium. Platinum's still a small market, though, so an increase in demand will almost certainly, all things being equal, move the price higher. I think the story for platinum is more about the substitution. So can you get automakers to substitute palladium for platinum? And I think the longer-term picture is also about this new propulsion systems, particularly hydrogen fuel cells. You need platinum there for the catalyst in the fuel cell. We're seeing a lot of good news, particularly out of the big truck, the semi-truck market. Good showing there in terms of hydrogen vehicles being put on the market, particularly from Nikola Motors. And so I think that's very promising. It could be a good demand source for platinum going forward. But right now, I think the major story would have to be on the substitution side.
I didn't ask you about gold. I've known this guy for like 15 years, and we didn't talk about gold. Will Ryan of Granite Shares, thank you very much. Great to see you.
Thank you.
And time now for the note of the week, and today comes to us from Goldman Sachs. CEO David Solomon wrote an op-ed in the FT saying, quote, companies have traditionally treated sustainability as a peripheral issue. We don't have the luxury of that limited perspective anymore. Over the next 10 years, Goldman Sachs will target $750 billion of financing, investing, and advisory activity to 9 areas that focus on climate transition and inclusive growth. Now, investors are really into it. This chart shows the growth in sustainable investment strategies over the last couple years. Assets rose to almost $31 trillion in Europe, US, Canada, Japan, Australia, and New Zealand. The most popular approach, though, is still negative screening, which means excluding the so-called offenders from the funds. Coming up on this program, Deborah Perkins, ING's global head of food and agribusiness, will tell us how smart ag is helping to make farmers more efficient. Next on Bloomberg Commodities Edge. I'm Alix, and this is Bloomberg Commodities Edge. Time now for the BNEF brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. And today we look at the EU's historic climate goals. So the bloc plans to be carbon neutral by 2050, and it outlines stricter greenhouse gas emissions, revamped energy taxes, new rules on subsidies, greener farming, and what green actually means. So joining me now from London is Emma Champion from Bloomberg NEF. Emma, it was a really interesting couple days of meetings. What were some of your biggest takeaways from the EU?
So this is the first time that we're seeing a regional bloc actually go for a net zero emissions target, not just at the nation state level. We're looking at a collective ambition to go to net zero by 2050, in line with the goal of the Paris Agreement to keep climate warming below 2 degrees. And what this means is more than halving emissions from the EU overall from by 2030 from 1990 levels.
So how significant is that? Because this chart shows sort of where they are right now with existing measures, their current target for 2030, and their new target for 2030 when they're kind of like halfway there. That's a tremendous re-rating. How do they do that?
It is. It's an enormous step up in the level of ambition. Already we're seeing the power sector being the leading driver of decarbonisation in Europe, and we expect that trend to continue with coal closures as a result of high carbon prices and cheap renewables. This trend in our outlook is still looking pretty good out to 2030, and we could see more coal closures and phase-out agreements by member states. But the crux of the matter is that in order to get to this net zero emissions by 2050, they're going to have to look at new sectors that have been previously perhaps a little less of a focal point for emissions reductions. That means looking at transport, it means looking at how we heat our buildings, it means looking at heavy industry and really trying to push for more ambition in those sectors.
Is that going to happen? Are they going to get that from the government level? And do all the states actually have to agree to make it actually worthwhile?
Sure. So the main mechanism that the EU is looking at to ramp up that ambition in the way that they need is with the carbon market that we have here in Europe called the emissions trading scheme. So we're looking at a more ambitious cap by 2030 in line with these targets, and that will mean also expanding the scope of the carbon market to covering transport and buildings. Shipping is looking the most likely sector that will be tackled in this light, and I would expect that these other sectors will be a big component of discussions going forward. The final really interesting point is that there is this carbon border adjustment mechanism in place that will try to sustain that economic growth while also balancing out the need for those emissions reductions.
All right, Emma Champion of Bloomberg BNEF, thank you very much. We turn now to Commodity in Chief, where we focus on one executive in the commodity world, and today it's Deborah Perkins from ING. First, a closer look at her company. The world will need to feed 10 billion people by 2050, and you have to make the food in the right way without hurting the planet. The World Resources Institute says 3 gaps need to be closed to reach that goal. The 56% food gap between crop calories produced in 2010 and those needed in 2050, and a huge land gap, nearly twice the size of India, between global agricultural land area in 2010 and what's expected by 2050. And the gap between expected agricultural greenhouse gas emissions in 2050 and the target level needed to hold global warming below 2 degrees Celsius. Enter Smart Ag. Think of it as technology that helps producers find the right amount of seed, fertilizer, and chemicals. It makes farmers more efficient, better at managing inventory, and helps them cut costs and credit risk. This is where ING comes in. It works with everyone across the value chain, from animal feed, beef, pig, and chicken producers to processors, dairy, distribution, grain storage, packaging, transport, and restaurants. The goal is to help them grow their business, provide day-to-day working capital, and secure project financing to help meet these big goals. I recently caught up with ING's Debbie Perkins, and I asked her how the business was going to evolve.
We recently have done a couple of deals where the companies are getting the benefits of improving the sustainability of their businesses, and that gives them a benefit in their interest rate. So one of them was a cattle company, and so as they're looking at ways of sourcing it and their production techniques improving, they get a benefit from that.
So basically, they still take out a loan from you just to do their day-to-day, but if there's a sustainable element to it, you give them a lower rate?
That is correct. So it's usually for the larger companies where they are rated and that they can show, we will agree on some metrics of how they're going to continually improve the sustainability of their operations. But yes, as they hit these targets, then they get a lower or an improvement in their financing rates.
And then flip it. I mean, have you noticed sort of specific financing for sustainable things like dealing with waste management, maybe treating water, for example?
Yes, we're seeing a lot of companies are looking at that. So wastewater is a really good example of that. Also, looking at capturing different energy. The circular economy. So looking at how they can really use all of their output. Are there ways that they can incorporate that and improve their efficiencies?
What are some of the trends that you think then you're going to see in the next few years as not only the need to be sustainable picks up, but also the demand for loans that then they can kind of get a better deal on?
There are a lot of investors that are becoming increasingly interested in sustainability. So that is, one of the factors that these large food companies are dealing with. So we will continue to see our companies looking at what investments they need to do for that. I think, particularly in Europe, where this is a really big issue, we'll continue to see evolutions as people look at what are the best ways of doing this and how can companies show that they are and get recognition. I think that's a big part of it for a lot of these companies, is how that they can get recognition for the investments and for what they're doing in regard to their sustainability.
Where's the low-hanging fruit? Sort of what can they do to pull these easy triggers on sustainability, and then what's more of a longer-term investment, slow turnaround process?
I think it depends a little bit of where they are in the value chain. Water is going to continue to be important, so looking at that. Solar and wind, like alternative energy sources. I think another thing that we're starting to see too is packaging, which is obviously a big part of it. And the other one that I would mention would be food waste. We do waste a lot of food in developed countries, and it's not a simple issue to solve, but I think that's something that there's a lot of small companies looking at what they could do to improve that aspect of the value chain as well.
That was my interview with Debbie Perkins of ING. And one more commodity you're going to want to check out, vibranium. Wakanda is no longer listed as a free trade agreement partner of the U.S. The USDA removed Wakanda from its tariff tracker this week. Bummer, because it's the made-up country from Black Panther. The USDA said they actually used Wakanda when testing the system behind the tracker and had forgotten to remove it, but apparently there were tons of commodities actually on the list. Ruh-roh. All right, that's it for me on Bloomberg Commodities Edge. Join us every Thursday at 1 p.m. New York time. This is Bloomberg.